You think the mortgage is the scary number. That is the number you underwrite your life around. You clear underwriting, survive closing, and tell yourself that as long as the rate is fixed, the house is stable. Then the renewal email hits. Your homeowner's insurance premium jumps so hard, it stops feeling like a side bill and starts feeling like a second mortgage. The first reaction is denial. Maybe it is a typo. Maybe the carrier uploaded the wrong document. Maybe the monthly escrow draft will barely move. Then you open the renewal packet, and the new annual premiums is sitting there in clean black numbers, completely calm, while your brain does the opposite. You are not looking at a cosmetic increase. You are looking at a bill that just moved into the center of your housing budget. That is the part nobody really prepares you for. You can buy the house at one monthly number and keep living in it at a very different one. The renewal is always rude because it arrives with no ceremony, no open house energy, no lender smiling, no keys on a table, just a PDF and a deadline. If the policy is escrowed, the shock is delayed but not softened. The servicer pays the bigger premium, the escrow balance goes short, and the next statement quietly tells you your monthly payment has changed again. Now you are not just paying for insurance. You are paying for the insurance increase and the escrow catch-up. That is how one line item starts hijacking the whole payment. The loan itself did not explode. The rate did not reset. Insurance just walked into the room and demanded a larger cut of your life. And because it is housing, you cannot treat it like a streaming subscription you cancel when it gets annoying. If the lender requires coverage, the bill stays in the stack. At closing, insurance feels small because it is usually presented as one input inside a bigger monthly estimate. Principal, interest, taxes, insurance, the brain compresses it. It feels like one calm ingredient in the mortgage recipe. But insurance is not fixed the way people emotionally assume it is. It reprices. It reacts. It moves with claims costs, rebuilding costs, location risk, carrier appetite, and the simple fact that insurers can decide a place or a property now costs more to cover. That is why the phrase fixed mortgage payment tricks people. What is fixed is the note rate on the debt. The total housing payment is still exposed to taxes, insurance, and every other cost orbiting the property. So the day the insurance bill surges, it does not feel like a normal adjustment. It feels like the house changed the deal after you signed it. This is not just your imagination. ICE Mortgage Technologies, September 8, 2025. Mortgage Monitor says the average annual property insurance payment for single-family mortgage holders climbed to nearly $2,370 a year and rose nearly 70% over the previous 5.5 years. ICE also says insurance now accounts for 9.6% of average monthly mortgage-related expenses. 1 out of every $10 in the average monthly housing payment is now going to insurance alone. Read that again from the homeowner side, not the economist side. Every $10 you send into the machine, about $1, is just there to keep the policy alive. The U.S. Treasury's January 16, 2025 report on homeowners insurance found that average premiums per policy increased 8.7% faster than inflation from 2018 through 2022. Treasury also found higher risk areas had higher claim severity, about $24,000 on average, compared with about $19,000 in the lowest risk areas. And those same higher risk areas were more likely to see policy non-renewals. So even if your personal house has never filed a claim, the market around your house can still reprice you. That is what makes the increase feel unfair. You are not only paying for your own roof, you are paying for the math of the region, the materials market, the claims environment, and the insurer's willingness to stay in the zip code at all. Insurance does not need to literally exceed principal and interest to take over your mortgage emotionally. It only needs to become the bill that destabilizes the budget. It is the bill you cannot predict well, cannot ignore, and cannot negotiate the same way you negotiate a phone plan. And when it hits through escrow, it contaminates the mortgage payment itself. Suddenly, the payment you thought represented the house is really the house plus a fast-moving protection cost you barely control. That is why the stress lands differently. The mortgage felt like a contract. The insurance renewal feels like the contract got edited in the dark. You start staring at the house differently after that. The roof is not just a roof anymore. The siding is not just siding. The trees near the structure, the age of the systems, the replacement cost estimate, the deductible, the weather map, the prior claims history of the area, all of it starts turning into money in your head. Then the secondary damage starts. If insurance rises, the escrow payment rises. If escrow rises, the monthly payment rises. If the monthly payment rises, the rest of the budget shrinks. Maybe the emergency fund rebuild slows down. Maybe the appliance reserve never really gets rebuilt. Maybe the repair you were going to do in the fall becomes a next year problem. Maybe eating out disappears. Maybe travel disappears. Maybe the house keeps the address and takes the flexibility. And from the outside, nobody sees the shift. They just see a homeowner with a mortgage. They do not see a homeowner learning that the carrying cost of a property is really a moving stack of obligations. And one of the fastest moving pieces is insurance. That is why this kind of increase feels personal. It is not just a number. It is a reminder that the expensive part of ownership did not end at closing. It keeps renegotiating with you. You stop treating the renewal notice like a passive document. You shop early. You compare carrier quotes before the deadline, not after. You check whether the dwelling coverage still makes sense, whether the deductible trade-off actually helps, and whether small property hardening fixes can change pricing. If the roof is aging, you find out what that does to the policy before the carrier tells you. Then you review escrow on purpose. You do not wait for the mortgage statement to explain your life to you. You look at the new premium, the projected shortage, and what that does to the monthly payment. You build a housing reserve that includes insurance volatility, not just maintenance. Because if insurance is now a faster-moving cost, the budget has to admit that reality. You thought the mortgage was the thing carrying the house. Then the insurance renewal showed up and reminded you the house is being carried by a whole stack of bills, and one of them just got heavier. Welcome to StatPsyche,